So the Fed meets again this week. And guess what? There's about a 0% chance that they're going to raise rates this month. So that's really good news. That being said, all that talk, that meeting that they're going to have this week doesn't mean that it's all for naught. They're going to give us some interesting information during that meeting. So one of the things that they're going to be doing is they're going to give their anonymous forecast of the future economy, specifically Fed funds, inflation, GDP, and unemployment. That means that you don't know who thinks what is going to happen to the economy. It's all anonymous. And obviously, J. Money Powell's opinion or forecast might be more important than others. And, some people's opinions might be more than others. We are not going to know who thinks what, but at least we will get what they think. They're also going to show where they collectively think interest rates are going to go in 2024. So I anticipate that interest rate cuts are going to get pushed back to at least mid-2024 and maybe not even until year-end 2024. So high rates are making it very easy for real estate investors to keep their money in the bank or treasuries earning 5% and just sit back and watch what happens. There's still a lot of uncertainty in the market. And so when you're not confident, what else do you do? Well, in this economy, at least you have treasuries that you can put your money in that's making you 5+%, sometimes even more. So that being said, banks are still lending, but because they're being more conservative and because cap rates really haven't gone up that much, we're still seeing a lot of transactions requiring a minimum of like 50% down on deals. I am also, though, seeing brokers are actually saying that sellers are willing to negotiate prices down. So that's a really good thing. So anyways, lots of investors are still buying properties with cash or assuming debt. That's what I'm seeing much more these days, is either paying all cash for properties or you're assuming the debt. That is if the lender will let you. Not all lenders are being very easy with assumptions right now. So for example, if you are a seller or you have a seller who's extremely wealthy, then they're going to want to see, some banks are saying, we want to see someone who's going to assume that debt, who's about as strong as that person. So where it gets a little tricky is where you have the random one-off investors who maybe own 5 units or even 20 units, and they're worth $50 million. And then you're a guy coming to try to buy, or you have a buyer coming to try to buy your building. And it makes a lot of sense because they own maybe a handful of buildings that they're trying to trade up into a 20 unit, or maybe they have another couple larger buildings, but they're not worth $50 million. So that's become an issue for us with some assumptions, with some lenders. So it's something to look out for. So if you're planning on listing your property, then you really want to speak to the lender first and really understand what they're requiring for assumptions, because it's not that cut and dry in this economy. Now, as far as treasuries, have you guys seen they've still been on the rise? In fact, the 10-year treasury is dangerously close to another key psychological level of 4.35%. We're kind of hovering around 4.31, 4.33, 4.34, but we haven't hit the 4.35. If we see it hit that, we might see it run up as much as another 50 basis points, just like we did after it passed the last level of 3.92. Now, why is this happening? Why are treasuries going up, specifically the 10-year treasury? Why is that on the rise? Well, one of the biggest reasons is that everyone's finally believing in higher rates for longer. That means that interest rates are going to stay higher for longer than we originally thought. So it's not just us either. As our rates rise, the value of the US dollar moves up too. So foreign central banks have to deal with currency weakness relative to our strengthening dollar. One of the best ways to prop up your currency is to buy it. So demand drives up price, but an even better way to sell assets is in the currency that you're weak against. So, and then you use those proceeds to buy your own currency. So for example, we'll talk about Japan. Basically, Japan is selling US Treasury holdings, and then they're turning around and taking that cash that they got from selling US Treasuries to buy their own currency. Okay, this simultaneously weakens the dollar while increasing the value of their own currency. That also happens to push up treasury yields. So this is happening globally. I'm picking on Japan right now because it is happening quite a bit with Japan, but that's part of what's happening with treasury yield. So it's that, the market is saying that rates are going to stay higher for longer. So that's pushing up the 10-year treasury, and also other countries selling our treasuries, selling US treasuries to buy their own currency so that their currency doesn't get too too devalued. They don't want that to run away from them. So what else is going on? Well, let's just talk about ADUs because that seems to be all of the talk these days. That's how people are adding value. The process I'm hearing is actually getting faster as well, or has been over the last, 6 or 8 months. So 68,000 ADUs were built in California from 2017 to 2021. And there are 24,000 new permits in the state of California in 2022. So is this really helping the housing problem? Other states are starting to jump on the bandwagon where they lack land and the ability to add more housing the traditional way. So I was also reading an article about how mixed use projects are doing well. They cover office, retail, hospitality, and renters. So for developers, cities love them. Options for the community around them, and they're not stuck to one asset class. So that's what I'm seeing that's popular right now. So it's still the ADU play. That's still going strong for many, many people. But in terms of development, cities are really loving this mixed use development idea because it does create more options for the community while also adding housing. So not only that, but you guys, in a market like this especially, and I said this during COVID, so I just feel like it's been this continuous run, professional management can make a huge difference for some investors depending on your setup. Management could be also costing you money. So if you're an active investor or a syndicator, property management might be the best thing you want to focus on because focusing on acquisitions and building your portfolio is a much better return on time than dealing with tenant issues and late payers, leasing, and a laundry list of things. Now, that being said, it really just kind of depends on the type of owner that you are. When we had a management company, I would say this, we always had a really hard time. And if you talk to other property managers with owners that are going from self-managing to professional management. Why? Because they still think that they manage the property. They have a really hard time letting go. So I do know that it's really, really important to find a really good property manager. Don't get me wrong. A bad property manager can suck down all your cash flow. You can basically lose all your cash flow with a bad manager. But also at the same time, this is the same in life, right? Like whether you own a business, whether it's your household, or your property, you need to delegate certain tasks so that you can get a better return on your time. And what's the best return on your time? Looking for more deals, or raising more money, whatever that means to you, working in your job that it's high paying for you so that you can have more cash to invest. So just think about your return on time. I know a lot of people have a hard time letting go of the management of their properties because nobody does it better than you. And in some cases, that's right, because I know most of us owners care about the bottom line, like what is my cash flow? And you might think that a property manager can't do it as good as you, but there's a whole laundry list of other things that they probably know more than you, like the laws, for example, taking on some of the liability that will help you. And also, actually a good manager can make you more money because if you can take that time to go make more money, then I would hire. For me, I say my property manager is worth their weight in gold. You could not hire me. You could not pay me to take over the management of my properties. So that's the way I feel about it. If you have any questions, let me know. I'm happy to steer you in the right direction. Not only that, guys, but let's talk about the rent. The US median rent in August was $2,052. That's just $2 shy of the record high from the prior year. So a year ago, to achieve these rents, you weren't seeing concessions in the market like you are today. There are more move-in specials. Landlords are having to do move-in specials to fill units. And for many parts of the country, they have much more competition than they did 1 year ago. Completed units are up 28% from a year ago, and that means there are more vacancies to fill. I have been talking to other owners throughout San Diego, and I'm hearing the same thing too. Units are not filling as quickly as they were before, and they are having to offer more concessions and more move-in specials to get those units filled. So you guys, what's coming up for the week? The Fed is going to speak, and there's almost 0% chance that the Fed's going to raise rates, like I said, for September, but there is about a 28% chance that they will in November. Still very low. It's dropped quite a bit, to be honest. So let's see how all of the information comes out over the next few months to see if we're going to get one more pop before they go on an official pause. Have a great week, everyone, and thanks so much for listening.